This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This lecture goes through question 1 from June 2013. You are strongly advised to download this question from the ACCA website. I also suggest that in a moment you stop the recording and you spend, say, 10 minutes reading carefully through the question and its requirements. We will be doing this together, but it's useful if you were to read through first, and then you can compare perhaps what the question said to you, meant to you, and you can compare that to maybe what comes out in the lecture. So this is a good place just to pause the lecture, make sure this is downloaded, and to read the question and requirements carefully. Okay, we'll read through the question and we'll kind of annotate as we go, so that this is what you should be doing. This is part of your planning. You have reading time before the exam really starts, and you should be reading particularly the large question to make sure you become very familiar with it. You should always go to the requirements first. So let's see what they are. The requirements give you warning as to what the question is going to be about, and then as you read through the question, you can read through it with a greater sense of purpose. So here we have requirements. Write a report to the CEO, and the first thing we have to have taken in here is that we are writing a report. So we have to go through the hoop, really jump through the hoop. We have to head it up to, from, about, date, and so on, and probably numbered paragraphs, introduction, and then numbered labeled paragraphs thereafter. Whether it's just an answer, whether it's a report, whether it's a memorandum, whether it's a letter, it doesn't make much difference to the contents of your answer. It's to some extent window dressing, but it's window dressing that could be worth 2 marks, and silly not to go for it. Part 1. Explain the characteristics that differentiate service businesses from manufacturing ones using Colmog to illustrate your points. So here we have a kind of 2-part question actually. There is a very factual part here, the characteristics that differentiate service businesses from manufacturing businesses, and that's really a standard list of about 5 different qualities. And then secondly, very important, using Colmog to illustrate your points. So it's presumably about half a mark for knowing what the characteristic is, and about half a mark for illustrating that using Colmog. Secondly, evaluate the current strategic performance report and the choice of performance metrics used. That's used in Appendix I. And this evaluation of current performance reports is a very common requirement. Evaluation implies a kind of potentially plus and minus. There's almost a pros and cons. There's a judgment going on in evaluation, and you should be prepared to criticize. There may be some good points, but on balance, if it's going to be worthwhile as a question, there's going to be quite a lot of criticism that you should be looking for when you come to look at this performance report. Evaluate the balanced scorecard in Table 1 and suggest possible improvements. So here we have Kaplan and Norton's balanced scorecard, and you either know that or you don't. If you didn't know what the balanced scorecard was, there may be a little bit of help when we get down to Table 1, but there's a real risk that you're going to be a bit lost. Describe the difficulties in implementing and using the balanced scorecard. 7 marks. So there's, in a way, 19 marks in total there. The 12 and a 7 going on balanced scorecard. And then secondly, explain the purpose of setting targets which are challenging and evaluate the standards and rewards for hotel managers' performance reward system as requested by the CEO. So some stuff here, there's presumably some rather theoretical stuff, the purpose of setting targets that are challenging, and then we get down to the practical bit. There'll be some particular performance reward system that we either have to criticize or invent or to think about. So 4 professional marks then going for this. So a lot of professional marks in this question. Certainly 2 of those would be for, I think, setting it out in the form of a report. Okay, well, let's go back and read through it carefully, having alerted ourselves as to the basically the characteristics, if you like, or the requirements that we're going to have to be reporting on in our answers. So here we go. I want to just read through it fairly gently, but underlining stuff as we go. Kolmog Hotels is a large listed chain of branded hotels in Ostland. Its stated mission: to become the #1 hotel chain in Ostland, building the strength of the Kolmog brand and consistently delighting customers, investing in employees, delivering innovative products and services, and continuously improving performance. There is quite a full mission statement there. Why has a mission statement been given to us? Well, if you remember right back to the beginning of the lectures, we were saying, well, what is performance management? We divided that into 2 parts. What is performance? What is management? And we said is really that performance can be anything you like. Performance is dependent on the organization, and we have to relate that back to the organization's mission. The mission of a profit-seeking organization is going to be quite different from the mission of a non-profit-seeking organization, and therefore certainly the performances are going to be evaluated and measured in very different ways. So here, when we come to part 1 of the question, and it says, part 2 of the question, and it says evaluate the current performance report, we have to make sure that the performance report targets what we hold to be good performance, and what we hold to be good performance is really summarized in the mission. So we've got in here to become the #1 hotel chain in Ostland. So there's an idea of we want to be a leader of some sort, building on the strength of the brand by delighting customers, investing in employees, delivering innovative products and services, and continually improving performance. And then it goes on to say the subsidiary aims of the company are to maximize shareholders' wealth, so that's certainly part of performance, and to create a culture of pride in the brand and to strengthen brand loyalty of all stakeholders. So whenever we are looking at a performance report, we need to make sure that it addresses all of these things. Is there anything in the performance report, for example, about delighting customers, investing in employees, delivering innovative products and services? The hotels of the Kolmog chain include a diverse range of buildings and locations serving different customer groups: large conferences, city centre businesses, country house hotels for holidays. Now there's quite a bit of detail given here. There's a diverse range of buildings and locations. There are many different hotels here, and it may be important if you were the managing director, the CEO of this organisation. You might expect, in a way, different performance from different sorts of hotels. So the city centre hotels might be relatively cheap for people to stay in, kind of, ordinary business hotels, but maybe they're going to have some upmarket hotels for conferences and for holidays and for wedding receptions and the like. For reporting purposes, the company has divided itself into 4 geographical areas. As we've seen from the recent example, again, that's going to be in Appendix I. We'll look at that presently. At the operational level, each hotel manager is given an individual budget for the hotel, prepared in the finance department, and is judged on the performance against budgeted profit. So that's not looking so good. There's nothing wrong with being judged against budgeted profit, but given the big list of qualities that were in the mission statement, perhaps being judged against budgeted profit is shallow. That we should maybe find some additional things to be looked at. Budgeted profit, if you exceed it, is certainly going to presumably help to maximize shareholder value, but not much else. Kellogg is planning a strategic change in to its current business model. The board has decided to sell many of its hotels and to rent them back. This is consistent with many hotel companies who are focusing on the management of the hotels rather than managing a large portfolio of hotels, rather than being worrying with the properties and so on and being a property company. In order to assist this strategic change, the Chief Executive Officer is considering introducing the balanced scorecard across Kellogg. He has tasked you, as a management consultant to head office, with reviewing the preliminary work done on the development of the scorecard in order to ensure that it is consistent with the goal of meeting strategic objectives of the company and tying operational and strategic performance measurement into a coherent framework. So I would say they see you on the right lines. One of the great things about the balanced scorecard is it spreads what you're looking at over in particular 4 headings here. We should know what that is. If you don't know what it is, then again you're going to be difficult, but maybe there's a little bit of help further on down. The CEO is worried that the BSC, that's the balanced scorecard, might be perceived within the organization as a management accounting technique that has been derived from manufacturing sector. And of course, that's probably where it started off, but can it be applied to a service sector? In order to assess its use at Kellogg, he suggested you explain the characteristics that differentiate service businesses from manufacturing ones. And really, that's really, I suppose, looking here at part 1 of the question. Senior executives at head office have drawn up preliminary list of perspectives and metrics at the outline, as an outline of the balanced scorecard in Table 1. So here's Table 1. We do get a little bit of help here to balance scorecard. There is basically a financial perspective, as it's called. There is the customer perspective. There is down here, this is not quite the name of it, but it would normally be called internal business perspective. So presumably what this is getting at. How well is the hotel doing against budget is what they've taken as an internal business perspective. And then we have employee satisfaction, which have taken as the perspective that really should be innovation and learning. So they haven't quite got it right. They haven't actually done the balanced scorecard, and they're not doing it very well at all. The history of rewards at Kellogg has not been good, with only 1% of staff receiving their maximum possible bonus in previous years, and 75% receiving no bonus at all. This has led to many complaints, as the targets are too challenging. One of the things that you may remember about setting bonuses and performance-related pay and so on, if you're going to be motivating people, is that people must feel it's A, worthwhile to get, and secondly, that there's a chance of them getting it if they work reasonably well and efficiently. We might be able to bring in here expectancy theory, to Vroom's expectancy theory, which brings in both of those aspects. Under a new performance reward system, employee targets are to be derived from the above BSC strategies. So we're going to be tying in rewards to that. Depending on the employee's area of responsibility, well, that's good, because one of the things you ought to be tying in with is, can I affect my bonus? Is what I'm doing, the decisions I'm making, the way I function, if this can't possibly affect the outcomes, then it's not really fair or logical to connect bonuses to that. So the new system is for hotel managers to be given challenging targets based on a hotel's performance against budgeted profit, industry-wide staff turnover, and the company's average customer satisfaction rate. So there's profit, staff turnover, and satisfaction scores. So the bonus is being tied at least to more than just financial. It's almost got in here the elements of this balanced scorecard. Hotel managers will then get up to 30% of their basic salary as a bonus, based on the regional manager's assessment of the performance against these targets. Now this is a little bit tricky. Based on the regional manager's assessment of their performance against these targets, because one of the things that's good to see in a kind of bonus scheme, profit-related pay, is a kind of transparency. That is a relationship between how I do and what I get as a bonus. And if we have the regional manager coming in between and then making slightly arbitrary or maybe subjective decisions about what the bonus should be, then people can easily get disaffected. You begin to think, well, I haven't got a bonus, not because you didn't perform, but because the regional manager didn't like me. So inevitably, I think there's going to be some element of judgment in some of these qualities, because one of the difficulties will be it can be hard to assess, for example, employee satisfaction and so on, and the like. But you don't want there to be too much. The CEO wants you to use Fitzgerald and Moon's building blocks model to assess the new system. So this question really is going to town on non-financial performance measurements and the theories surrounding it. So if we didn't know Fitzgerald and Moon, again, we're going to be at a big disadvantage in answering this part of the question. He's happy with the dimensions of performance, but wants your comments on the standards and rewards. So a little bit of a hint there, because we're looking at dimensions, standards and rewards, which is basically the building blocks, or the overview of the building blocks in Fitzgerald and Moon. Here we have Appendix I. This is the current strategic performance report. Okay, so we've read it, we have thought about it, we have annotated it, we have tried to tie back, I think, what was said in the question with the requirements, because you would expect that. I mean, these questions are designed, the requirements are designed so that there'll be something in the question relating to them. They're not just kind of separated or kind of random. Okay, well, let's think about part 1 here. Characteristics that differentiate service businesses from manufacturing ones, using Colmog to illustrate your points. Now, what I want you to do is to write down as many of these characteristics that differentiate as you can. You should be looking for 5. And then if you can, think in a context of a hotel chain, which is what Colmog is, how could I use that to illustrate these 5 characteristics? Okay, here is how service businesses differ from manufacturing businesses. First of all, heterogeneity. This means that what is supplied to each customer tends to be very different in service industries compared to manufacturing industries, where very often it's mass-produced identical products. In terms of a hotel, we were told they had a range of hotels, so the products are going to be different. Even within a hotel, there can be different standards of rooms, and there can be maybe different restaurants and so on with different meals. So very much what you give to a hotel customer, unless you're in a very, very kind of standardized chain of hotels, which is not the case here, I think, each customer is going to get a kind of unique service. Perishability. Perishability means that after some time you cannot supply the product or the service anymore. In the context of hotels, it means that once a night has passed, you can't sell that night. You can't sell that hotel room again for that night. The implications for something like a hotel business is that if you have know that particular times of the year or particular times of the week, for example, it's usually slack. There are many empty rooms. If you don't have somebody in the rooms that night, you're losing that revenue. So perhaps what they do is they have flexible pricing. So at busy times of the week, they've got quite high prices. At slack times of the week or the month, they've got quite low prices, just to entice in the marginal revenue. Intangibility. You can't touch something, you can't see something. Obviously, you could show someone a room if they wanted to see that. But it's going to be impossible to perhaps easily convey to them how pleasant their stay in the hotel will be, the level of service which they're going to get from hotel staff. Simultaneity, basically the service is provided and consumed at the same time. What this might have implications for in a hotel is that if, say, the receptionist spoke rather sharply, rather rudely to a customer, the damage is immediately done. Whereas in a manufacturing business, you can subject what you've made to quality control tests and so on. Finally, no transfer of ownership. You simply rent somebody a room for the night or a seat in the restaurant for a night. Implications sometimes for service industries is that because you're not leaving with something kind of permanent in your hand and that the experience you get is transitory, you want to make the best of it whilst you're having that experience, and it sometimes leads guests, customers, to be particularly demanding. So these are the 5 elements. These are very standard. And what we're trying to do in all of those 5 is to say, in the context of a chain of hotels, and specifically Kolmog, illustrate these 5 elements. Part 2. Evaluate the current strategic performance report and the choice of performance metrics used. And that's in Appendix I. So let's go up to that. So it's evaluate. Remember we said evaluate, you expect criticism. There may be some good things, but there's going to be a lot of criticism. Let's make a judgment, is evaluate. And the choice of performance metrics. So let's look at Appendix 1. And here is Appendix 1. So, as we were told, the hotel was, they broke it into 4 different regions of the country. So here we have it broken down, east, west, north, and south. We've got the total for the year, the total for last year. We have percentages of revenue as we go down there. Towards the bottom, they've calculated some other figures for us. The capital employed, the earnings per share, the share price, and the return on capital employed. Now, the first criticism we can talk about here is, what we said right at the start. Why they're giving us the mission statement? Because the mission said that, in a way, good performance is to become the number 1 hotel chain, building the strength of the brand, delighting customers, investing in employees, delivering innovative products and services, continually improving performance. Subsidiary aims of the company are to maximize shareholders' value and to create pride in the brand and strengthen brand loyalty. And really, only one of those has been addressed in the current performance report, because it is all financial. We have got some things at the bottom here about maximizing shareholder wealth. Earnings per share would be, seeing that increasing is good, seeing the share price increasing is good. Having good return on capital employed is the way you generate the wealth, and that's fine. We have it compared to last year, and they've got the growth figures in here. But even before we get on to non-financial matters, what are the inadequacies in this? If we just look at as a financial performance report, not a strategic performance report, but a financial performance report. And the first thing that strikes me is they have not got the budget in there. Remember that the managers, I think, are being currently judged on how close or whether they exceed the budget. That's how they seem to be managing this business. And here we have compared to last year, but we don't have it compared to a budget, which seems peculiar. Secondly, they have divided it east, west, north, south, which might be okay if that makes sense. But why has it been divided like that? Certainly in the UK, the economy in the north of the country is really very different to the economies in the south of the country. If you say the south region includes the capital city, then almost certainly the south is going to have a better performance than the north. You'll be able to maintain higher room prices, and for example. So is there really any advantage in dividing it on a geographical basis? We were told at the start that the hotels include a diverse range of buildings, locations, serving different customer groups, conferences, business accommodation, receptions, holidays, and so on. Within the hotel, they've probably got little sub-ranges of hotels. So would it not be maybe more sensible to look to see, well, how have the country house hotels in the holiday business doing? How are the hotels that are primarily geared for conferences doing? What about the hotels which are for ordinary business travellers? Or maybe we should break it down into, profits earned from, overnight stays, ordinary overnight stays, profits earned from wedding receptions, profits earned from the restaurant, profits earned from the bars, profits earned from holidays, and so on. Would that not be a better way of understanding the business rather than grouping everything together and then making an arbitrary distinction between north, south, east, and west? What else could we look at here? Just kind of going down this here, and we have no idea really whether, for example, the eastern, let's say the northern region here is doing, to what extent is it doing better than the southern region, because we have no information on this about the number of hotels. So just say that the northern region is better because it is the highest revenue makes no sense. This simply may be where most of the hotels are concentrated, maybe for historical reasons. So unless we have some feeling maybe of performance per hotel, or some way of getting to that, or some way of scaling it, again, it's going to be very difficult. Anything else we could say, still purely on the financial side here, where we have cost of sales here. Cost of sales is presumably going to be stuff like the cost of food, maybe the cost of running laundries and so on there. But in a service business, the cost of sales are often very low. It's not like manufacturing, where the cost of material and direct labour is usually a very high proportion of the revenue here. And what we have done, okay, we have staff costs, but with these other operating costs, it might be quite interesting to know what those are. These are the highest costs for each of the regions here, and essentially they're all lumped together. And would it not be better to divide that down perhaps into rent, heating, depreciation, all the various costs that we could properly understand, and then when we're looking at the rental of certain hotels, we say, well, that's a very high rent compared maybe to the revenue from that type of group of hotels. So there's criticism here, even before we get away from the financial measures that are being shown in the report. It might also be worthwhile, again, there's no reason why we couldn't put this in here, it might be worthwhile breaking down over time into the 4 quarters of the year, because hotel businesses are often very cyclical. A lot of holiday stuff in the summer, a lot of kind of business conferences at certain times of the year, a lot of office parties at other times of the years, and so on. And it might be better to look at it for each 3 months to see the particular patterns that are lying behind it. Then when we depart from the financial report, which is here, and we say this is entirely inadequate, we have no idea from this report how close Colmog is to becoming the number 1 hotel chain here. So it says in here, mission to be the number 1 hotel chain. We have no comparative information about perhaps what's still the biggest hotel chain or what's the next biggest hotel chain, and so on. Not a clue how close we're getting to that objective. Second thing that we've got no clue about here, delighting customers and investing in employees. There's nothing in here about, say, customer satisfaction ratings. Now, we don't want to say too much about that, because maybe it's going to be looked at in the Boston Consulting Group matrix, but it leaves all of that out. It leaves out the idea of innovative products. It leaves out the idea of brand loyalty. I think that was one of the things in here, delighting customers, innovative products, continuing improving performance. Yes, the last thing here, the brand loyalty. We have no idea from this report about the number of customers who are repeat business. And you would expect repeat business to be some sort of indicator of brand loyalty. You'll be looking for, there's 8 marks for this, I think, 8 marks for this, and I think you'll be looking to say 8 things. It's not too bad in some of the financial measures. It could be improved by breaking down over the type of hotels, scaling to the number of hotels, and so on, breaking down the expenses into the different categories. So there's 3 or 4 things maybe to be saying in that. And then there's quite a lot to be saying is, how do we know we are the leading or not the leading hotel chain? How are we measuring customer satisfaction? How are we measuring innovation? How are we managing, measuring brand strength and so on? So brand loyalty. So certainly 8 things to be saying in part 2. Part 3. Evaluate the outline balanced scorecard in Table 1, suggesting suitable improvements. 12 marks, 4 items in the balanced scorecard. So presumably we're thinking of 3 marks for each of the perspectives in the balanced scorecard. Again, it uses the word evaluate. So there may be some good things to say about what they're doing, but we'd expect quite a lot of criticism of what's going on within that. So let's see at their attempt at the balanced scorecard. And remember what the balanced scorecard was. It is financial perspective, it is customer perspective, it is internal business perspective, which means how well you do what you proclaim you're going to be doing, how well you're carrying on your business, and then there's the innovation and learning perspective. So let's think about the financial performance. The first one here, the financial perspective, and it says, let's just make sure we answer the question, suggesting suitable improvements. Okay. For the metric for the financial perspective, they are looking at financial performance benchmarked to Colmog's main competitors, share price and return on capital employed. That's okay as far as it goes, that we're benchmarking with the main competitors, and I think benchmarking is important. But I think if we're just doing share price and return on capital employed, then maybe we're not doing quite so well. It might be quite interesting if we could work out, what the price per room is, because that's going to feed into our profits essentially. It might be interesting in knowing how our costs compare to other people's costs. So again, we can presumably easily find out, roughly speaking, how many hotel rooms our competitors are actually managing to sell compared to us. It might be interesting to see what that's like in financial perspective. It'd be good to compare it to budget. We've said nothing in there about comparing to our budget, as we said before. So share price, okay, return on capital employed. I would look at profit. I would look at profit growth. I would look at sales growth. I would look at gross profit percentage. Plenty of interesting. This is in many ways for us as accountants, should almost be the easiest part. Look at the financial measures which are missing, and that should be fairly easy for us to be looking at. Customer satisfaction, and they've decided to measure customer satisfaction survey scores, which is a start. It's not clear necessarily how many customers will be willing to fill one of these in. I think many customers simply won't bother, so I think a lot of their data may be suspect. But how else could you measure customer satisfaction? And again, I would come back and suggest, well, what about returning customers? What about looking at sales growth? What about if a new customer comes along, you ask them, how did you find out about us? And if they say, well, we found out about you because you were recommended to us by another customer, then that's pretty good news for us. We could look at websites such as TripAdvisor. We could look at the reviews on TripAdvisor or Booking.com and so on. There'll always be the number of deeply unsatisfactory reviews in any of these. But we would like to see most of the reviews coming in at 4 or 5 stars, and it'd be quite nice if we could set some improvements on that. Hotel performance against budget. This is the internal business perspective is what we're looking at. That's okay, not too bad. Variance analysis for each hotel. So we could be looking there at how costs are exceeding and so on. But it's only good so far as it goes. I mean, if you're looking at hotel performance against budget, surely for internal business perspective, you'd be interested in knowing maybe how full the hotel is, the average occupancy. I mean, that will feed into, presumably, the variance analysis for each hotel. But you will know how well you're doing if you manage to fill up the hotel. You will know how well you're doing, say, in the restaurant, if you can work out, the average restaurant bill, or how many people who are staying in a hotel also eat in the restaurant. Because if they're staying in a hotel and they choose not to eat in the restaurant, are we doing well what we're proclaiming to be doing, insofar as we are giving people a good kind of residential experience and the like? We could be looking also at, maybe the price of meals, the gross profit percentage in meals and so on. We have to be careful not to get too much back up into the financial perspective, but we're looking here. We are supplying meals, we are supplying conferences, we are supplying wedding receptions, we are supplying presumably alcoholic drinks, we're supplying beds for the night and so on there. And we want to make sure that we are as busy as we can be in doing that. The final one should be innovation and learning. And of course, innovation was one of the elements in up here, in the mission statement here. And all I've got here is employee satisfaction. And that's okay, we could look at staff turnover. But why don't we also ask employees how satisfied they are? We could also easily look at lateness and sickness statistics to see perhaps how happy people were at work. But what about this business of learning? Employees need to learn. They ought to be going on courses. There can be hospitality courses. There are courses on health and safety in the kitchens and so on. There are courses on for waiters, how to serve food properly, wine properly, and so on. We could maybe be interested in how many of our employees are multilingual. So we want to get up the standards of language speaking to maybe attract ultimately a more international clientele and so on. Innovation. What have we innovated this year? Have we suggested new menus? Have we suggested maybe new deals, weekend deals, a double, two nights bed and breakfast for a certain cost and so on as a new offer? Have we maybe put in loyalty schemes? Anything of these sorts which we haven't tried before would be innovations. And if we want to have innovative products, then we ought to be doing that. We ought to be measuring it, and we ought to be setting targets. Because if they don't do this poor hotel chain is just kind of go along, boring old thing, and it will lose business to the more innovative ones. Part 4 asks us to describe the difficulties in implementing and using the balanced scorecard. I would draw your attention again to the double requirement within that. It's going to help us actually implementing and then using. So it gives us two chances, if you like, to think about something to say. So first of all, implementing a balanced scorecard. What difficulties might be put in the management's way? And first of all, we could say that there may be some staff resistance or maybe staff misunderstanding of what a balanced scorecard is all about. Staff have been used simply to dealing with financial measures, and suddenly in we come with all these measures on internal business perspective, innovation and learning perspectives and so on. So there could be some resistance, possibly from a lack of understanding of what we're trying to do. Second element in implementing the balanced scorecard is to decide on the metrics. What are we going to measure? We know there are 4 families to be measured, and if you measure maybe 6, 8, 10 elements in each of those here, you soon get up to a huge number of amounts which are actually being measured. Easily get up to 25, 30 different metrics, and that can be very difficult to keep them all alive, if you like, and we could almost get into overkill. So we have to decide what we're going to measure for, say, innovation and learning, and we have to be careful to choose measures or metrics which are going to be effective. You can measure many things, but not everything is going to be useful to measure. If you look at internal business perspective, there are all sorts of things that we could perhaps be measuring within that. You could start to measure at the number of packets of soap which were used by guests and trying to reduce that. But the chances of actually being a useful measure are going to be relatively small. So we don't want to overkill. We don't want to overload people with information. So we choose carefully what we're going to measure, and then we need to devise a system or mechanism for actually measuring it. So we need to implement effectively a reporting system. We can't just hope, if you like, that this innovation and learning or internal business perspective or whatever it's going to be is going to be measured kind of automatically just because we said. We need to, for example, implement returns, forms for people to fill in, show them how to fill it in, train them in actually being able to put down these measurements correctly and consistently throughout the group. So we've got at least 3 things there, I think, on the implementing of the balanced scorecard. Then there is using the balanced scorecard, basically interpreting the results which are coming out of it. And we have to understand a number of elements here. First of all, management has to understand the nature of the metric, and management needs to know that sometimes these metrics are going to be imperfect. So if you're looking at the occupancy rate of a hotel, then this could well drop maybe in a weekend where there's particularly bad weather, or in a day when there's particularly bad weather, so many people cancel their trips. And you need to make sure that allowance is made for this drop there. Or perhaps a hotel is undergoing innovation, a big one. Or perhaps a hotel is undergoing renovation, is being fixed, repairs, and some of the rooms are out of action. And again, we would need to make allowances in the interpretation of the metrics. We need to train managers in how to do this. We need to train managers to look behind some of these figures and to use them creatively. And when I say creatively, if somebody falls short of a measure, then you don't want to use that to kind of beat them over the head with. We should be using it in a way supportively, saying, well, how can we increase the occupancy of rooms? You can't necessarily say it's your fault the occupancy of rooms are low. There could be all of these external factors there which are needed. So there's interpretation of these and our response to the measures as well. And finally, I would say here is that if we're going to have these additional measures in, 25, 30 measures, whatever our balanced scorecard measures have gone up to, I can kind of envisage that people would use this for maybe 1 month, 2 months, where it's relatively novel, but then it will fall into disuse, and people will go back and begin looking at gross profit percentages and return on capital employed and so on, go back to their old ways, slipping backwards and not making use of these more innovative methods. Part 5 asks us to explain the purpose of setting targets which are challenging and evaluate the standards and rewards for the hotel manager's performance reward system as requested by the Chief Executive Officer. Again, almost 2 parts here. There's a theoretical part, explain the purpose of setting targets which are challenging, and that can be done without reference, I think, very much to Colmog, although we might want to bring it in. And then evaluate the standards and rewards of the hotel manager's performance system as requested by the CEO. And by this time we'll have forgotten, of course, what this performance system actually was. So let's just go back and see this. And I think it's this last paragraph here. So let's just read through that again. Under a new performance reward system, the targets are to be derived from the above balanced scorecard, strategic measures depending on the employee's area of responsibility. The new system is for hotel managers to be given a challenging target based on their hotel's performance against budgeted profit, industry-wide staff turnover, and company's average customer satisfaction scores. The hotel managers will then get up to 30% of their basic salary as a bonus based on the regional manager's assessment of their performance against targets. The CEO wants you to use Fitzgerald Moon's building blocks model to assess the new system. He is happy with the dimensions of performance, but wants your comments on the standards and rewards being applied here. The standards and rewards. Okay, so we're not going to be dealing with all of the Fitzgerald Moon because this person is happy with the standards and rewards. Okay, so let's see if we can remember what Fitzgerald Moon's building block models is all about. So see if you can just spend 10-20 seconds writing down what you remember about Fitzgerald and Moon. So here is the Fitzgerald and Moon building blocks model. And the question said, or the background to the question said, that the CEO is happy with the dimensions of performance, but wants your comments on the standards and rewards being applied here. So we must not really be saying anything about this, okay? So we'll just put a kind of pen through that. CEO is happy with the dimensions of performance, but wants us to comment on the standards of KPIs and rewards. But the question, if you remember, was in two parts. First of all, what is the point, what is the purpose of setting targets which are demanding? The purpose of setting targets which are challenging. Okay, so how can we get into this? Is there any theory we could apply? Is there anything backing us up? And again, I would, it's not in the ACCA model answer, but I would mention this business of room and expectancy theory. And it said that really the motivating force is equal to valence times the expectancy. So the valence is how much you want something, and here typically they're being offered a 30% bonus, and presumably they would want that. And the expectancy is your assessment of the probability that you will achieve this reward. And obviously the more challenging the target, the less the chances you're actually going to be getting this. So we've got a kind of balancing act going on here. We want to offer somebody a decent reward, but very, very important is that the reward or to get the reward isn't so challenging that people will simply give up. The purpose of setting a challenging reward, we could almost do kind of by diagram here. We could say that if you were this was somebody's natural performance, like that, and you set a target which is very undemanding, then almost certainly people's actual performance will go down. Whereas if you were to set a target which is reasonably challenging, then the performance will go up. If you were to set a target which is very, very challenging indeed, almost kind of impossibly challenging, and you say, well, no matter how hard I try, I'm never ever going to get this here, the idea is that will be quite demotivating as well. So the idea of setting a challenging target is to get people to run towards what you want them to achieve. They have to feel that they can get it. It mustn't be too challenging. Yet if it's not challenging, they're not going to get any great job satisfaction from this. The perfect target is a target which just makes you try that little bit harder to achieve something. And then the great satisfaction and pleasure you get when you actually get this quite tough target is immensely motivating. So in a way, is the sort of stuff I'll be bringing out for the first part of this element of the question, the purpose of setting targets that are challenging. Then it says, evaluate the standards and rewards for the hotel manager's performance. So standards, Fitzgerald and Moon says that when you're setting targets, the person to whom you're setting the targets should feel an ownership of those, which really means that you really buy into them, okay? And it probably means that you've had some say in setting what those targets are, because if you are kind of complicit in setting your own target, you will feel more loyal to it. it becomes very difficult to later on to say, well, I'm not going for that target because it's kind of imposed on me from outside. So the idea of participation is going to be quite important. Achievability, we kind of mentioned that already a little bit, not too high, otherwise you're going to demotivate people. Stretch them, that's what we're wanting. And fairness. Fairness both in setting the original targets and in judging whether or not somebody has properly got the target, or if they didn't get the target, that maybe allowance should be made. So what are the targets that are actually been set in this one? And we had here the hotel's performance against budgeted profit. Okay, now that should be all right, really, except I think we'd be worried about budgeted profit. What about ownership of budgeted profit? It said actually further up the question that the budgets were prepared by the finance department. There's no indication that the local hotel managers have any say over what the budget should be. So ownership might be missing there a little bit. Achievability, we've no idea. We don't know how tough these targets are, whether they are, compared to what last year's actual was, and you have moderate little improvements, or whether it's, some huge impossible jump. And fairness. Yeah, we can't set the same, income per room for each hotel if they're in different regions and different towns. We can't maybe expect the same occupancy room or the same profits and so on in each of the hotels. So we need to make allowances for different hotels with different clientele, different, basically different kind of land and buildings, different assets that they're working with when we're setting the profitability targets. Next one we have to look at we have industry-wide staff turnover. So we are setting a KPI on industry-wide staff turnover. Again, we were looking at ownership, achievability and fairness. And they come together a little bit here. What makes you think that industry-wide staff turnover is achievable in every hotel? It will depend, for example, let's say on achievability, on perhaps where the hotel is. So if you have a hotel which is in basically a holiday town, then quite often out of season you deliberately want to reduce the number of people working there. You may actually make them redundant, and then when it gets to the holiday season you're going to be employing more people. So the employment goes up and down, which implies quite high staff turnover. Whereas if you were a hotel in a capital city where the busyness, the occupancy and so on is going to be fairly even, then you'd expect the staff turnover to be lower. What would happen if wages were imposed on you from head office? Head office, after all, is imposing a budget. Part of that's going to be wages. What happens if you're trying to pay the same wages in London as you were maybe paying in a poorer city in the north of England, where the wage rates are much less? Trying to pay low wages in London with lots and lots of people looking for jobs, a very dynamic kind of situation, is probably going to give you much higher staff turnover there. And again, the fairness comes into it as well. Is it fair to be setting the same standards, or how are we making allowances for each of those? So there was an industry-wide staff turnover, and the company's average customer satisfaction scores. Company's average customer satisfaction scores. So what would happen if you were the manager of a run-down hotel? A hotel that needed maintenance, it needed upgrading and so on there. You are going to be marked down on the customer's satisfaction scores. Whereas if you were the manager of a brand new upgraded hotel, presumably customer satisfaction scores will be much higher. So we have a problem there with ownership, perhaps. A probability that some of these managers are going to be deeply offended by being given these very difficult targets. So achievability will be hard in some cases, maybe very, very easy, perhaps too easy in other ones. A beautiful new hotel is easily going to exceed the customer satisfaction ratings of the average. And fairness comes into this as well. Looking at different hotels and saying, well, here's the manager in charge of this hotel, we couldn't expect the same sort of performance. And very often, remember, you put your best managers in charge of the most troublesome branches and most troublesome hotels. You say it's a hotel with a bad reputation. You have to bring it up over the next 6 months. Clarity, motivation, and controllable. Is the clarity there? And I would maybe make a little bit of suggestion here that ultimately their bonus is based on the regional manager's assessment of their performance against these 3 targets. So that introduces, I think, a little bit of difficulty in maybe achieving all of this clarity there. This regional manager can be interfering and coming to some sort of objective decision. Motivating, it'll be motivating if people want the 30% of salary, and that to some extent depends on what industry averages might be in the bonuses. If in hotels the industry average bonus was running at 50%, we're only offering 30%, then although 30% seems generous, it may not be motivating. And also, again, comes back to don't make the KPIs too difficult. They must be achievable to get that expectancy, Vroom's expectancy theory working. And controllable. What are we going to do to a manager whose hotel is closed down for part of the year for renovation, or a manager who says we need to upgrade the restaurant because we're getting lots of complaints about that, and we say no, we can't do that, you're going to have to make do with your poor restaurant and so on. This manager will feel affronted, is saying, I can't control the restaurant. I can't control how well decorated the rooms are. I can't even control my prices, perhaps, because your head office will not let me put prices up and down. Yet I believe I should be tailoring my prices to local conditions, and you're not letting me do it. So the controllable there, your power over your bonus and so on, has been eroded, and that can be deeply, deeply, deeply disturbing to managers.